Hello, my name's Alison Trant and I am part of PKF's Banking and Funding Advisory team along with my colleague Jeremy Richards. We are a relatively recent addition to the firm, having joined in November last year, and we join from a banking background, having spent over 20 years working for various high street banks in both the commercial and corporate divisions. We have been brought in to broaden the firm's existing debt advisory capabilities. So this is our first joining of the finance seminar. So I thought we'd take the opportunity just to share about this, our new service proposition for you as clients of the firm. So I'm referencing here, we have the full banking background. So we've got access to all of the banking and funding products. I think what's of most interest, however, is that we have spent the last 5 years in the finance brokering alternative funding space. So not only do we have access and good knowledge of high street banks and their propositions, but importantly, the challengers and what's referred to now as the alternative funding market. And I will go into this in a bit more detail throughout this presentation. Just further to that in terms of what we do and what does this actually mean. So part of it is who we know. We have an extensive network of lenders themselves. We make reference here to at least 150. There are new ones cropping up all the time. So this is the high street banks, the challenger banks, and alternative forms of finance. Also, within those lenders, we have a very large black book of senior contacts. So we find this is really valuable for businesses in terms of we just know the right people and indeed some of the best people to be able to speak to. So that's who we know. And then there's a case of what we know. Over those 20 odd years working in high street banks, we have accumulated an extensive product knowledge. We can bring these to the party in helping you in your funding discussions. I come across it quite often. There's a number of products out there that people just don't know exists, and that's what we aim to bring to the party. Alongside just the actual product knowledge, we bring what we refer to as structuring expertise, and this is meant in terms of bringing experience of ways that you can structure facilities or challenge the banks on the terms that they have issued, or indeed any lender in terms that they've issued, to get the best possible facility for your requirements. What do I mean by that? Such things as, for example, we can help challenge some of the covenants around setting, making sure they're appropriate, or indeed if there's any other covenants that might be a better fit. Or indeed just challenging around the setting of those covenants and the frequency of testing. For example, had a client last week that was still under monthly testing, which was quite a time-consuming exercise for the finance team to send the testing pack to the bank. So the facility had been in place for quite some time. It wasn't really adding any value anymore. So those are just the sorts, and they hadn't ever thought to challenge the bank on relaxing some of on the frequency, but that's what they agreed to do, and so we've saved that client some time. Other ways in which what we know, quite often we will help challenge some of the security that's sought. Probably the most common one we come across is when the lenders have a requirement for a personal guarantee. We want to understand, first of all, the full rationale for that. If it is still deemed a requirement, then there's some negotiating tools you can use. We would look to introduce caps. You can indeed insure them, or we would look to include review points or subject to certain performance parameters that personal guarantee requirement can be reduced or indeed ultimately removed. So that's the kind of who and what we do. But how does could this potentially help you as a client of the firm? Well, we like to consider yourselves perhaps part of your finance team to come alongside you when you have any banking or funding requirements, and use our banking experience and knowledge on your side of the desk. One of the most significant benefits that we bring is saving you time. I've just alluded to the funding marketplace is now extensive, and we're scouring it and keeping on top of it at all times. So it would save you having to go out and research. You might not even know where to begin, or indeed holding separate conversations with lots of different lenders. We would do that on your behalf. One of the other things is we can, I've referenced it as well in terms of the structuring expertise, we can negotiate aspects on your behalf. And the little pizza reference on the slides is to the fact that we can get involved as much or as little as you wish. Depends on your own experience, your own capacity. We sometimes just come alongside as an initial advisory to the other end of the spectrum, where we can take over and run the entire funding or banking conversation on your behalf. So that's us, a bit about what we're here and what we do. And so I thought I'd turn our attention to just actually having a look and sharing with you some of the things that we are seeing in the lending market at the moment. So, well, interest rates, probably one of the most important factors. We're using the SONIA as the reference rate. It generally tracks just above base. So what is it telling us here? We can see, well, hopefully good news. It's on the downward trajectory, getting the current forecast, and this is taken as at today's date at the time of recording, which is the 17th of April. It's currently telling us that the borrowing rates are projecting downwards to just above 3% over the next 4 years. So this is good news, as we've all just experienced some pressure on interest rates. Turning to the next slide, I just thought this was a bit of a useful snapshot into that alternative funding market that I mentioned earlier. So this data is extracted from the British Business Bank. They conduct a fairly extensive survey of SMEs every single year, and this is one of the outputs within their report. So on the left here, it's referring to and delving into the number of funding lenders that SMEs have spoken to and when they've required some new debt. You'll see the vast majority, 59% is the data in 2022, are still speaking with just one lender. And then over onto the right-hand side of this sheet, it's the reasons why they're engaging. And I don't think it would be surprising that working capital is dominant. Over half of the requests for new lending were for working capital, as I say, in the pressures that we've seen on supply chains and indeed rising costs. We are seeing working capital reduce, and hence people are approaching their lenders to increase their facilities. A positive on it is that there's also a really decent percentage, just under 30%, is for growth funding, either the purchase and investment into new assets or indeed just some additional growth capital. So these are positive signs. But as I said, the one for me that we were monitoring here is that still the vast majority of SMEs are only going to one source of lender. Which brings me on to this slide. So this again is from that British Business Bank work survey with SMEs. What we're seeing here, and which I think is quite telling, is this is of lending deployed, the share between high street banks or the big 5 major banks, and then all the what we refer to generically as the alternative funding space. For the last 6 consecutive quarters, the alternative funding market has deployed more funding than the 5 major banks, and I think that's quite telling. So a total of 35 billion in 2022. Moving on just from the high street banks and the challenger banks. This is again from the same report, but another form of funding and by way of private debt funds. And you'll see here a steady increase in what they refer to as dry powder. The amount of private debt funds available has been rising quite significantly. It's actually more than doubled since 2017. Some of the recent increase of availability in private debt funds is actually driven by two factors. They didn't deploy just quite as much in 2021. So they're sitting on some funds, but also more importantly, and I think the more positive thing is that there are new entrants into this market. This is great news for SMEs. The private debt funds offer more flexibility in structures and are much more likely to get involved at different parts of the economic cycle and in your growth cycle as an SME than you would experience typically from a high street bank. So the summary of the point that what we're trying to get across of what we're seeing at the moment is there is generally really good liquidity and available in the market if you know where to look for it. Wanted to just touch on this as well. So funding in support of businesses' ESG strategies. Our fellow presenters will be touching on ESG in relevance to their subject matter, and it's also relevant in the lending sector now. What we are seeing in this space is more and more lenders specifically coming out with ESG products. One of the major banks in particular will offer a discount on the borrowing margin if you can prove that you're meeting certain ESG improvements in your business. So we really are seeing a very conscious move and deliberate move, let's say, supported by products into this space. We had a recent example as well for a fairly sizable £16 million real estate fundraise that was so far, it was the high street banks were competing for it, and one in particular went so far as that they wouldn't issue terms without the production of an ESG strategy paper by the client. And I think this is a trend that certainly we're going to see increasing. But what's just obvious is every time we catch up with the lenders, this subject matter is becoming more and more prominent. This data that I'm referencing in this slide here is again from the British Bank Survey of SMEs in terms of what you're telling us your thoughts are on ESG funding. And we can see that this is a reflection of these trends. Lots of people we can see from the graphs here, people are conscious of it, aware of it. Certainly, at least the green aspect of it is people are starting to think about it. And as I say, just from our experience and conversations, it's just becoming sort of more firmly on the agenda. The right-hand side of this slide is referencing to what is holding people back, perhaps doing more ESG activity. The biggest factor that was reported last year was the economic conditions. There were bigger fish to fry in terms of keeping their businesses afloat and functioning. So that diverted some of the attention away from focusing in on ESG facilities. They're also referencing here, perhaps I wouldn't know how to fund any of these activities. So that again is something that we would encourage you to be speaking to lenders about. We are starting to see them come out and be very, very supportive of ESG projects. So again, yeah, just to encourage to speak to lenders on this matter. So a bit of a summary then. I hope it has helped provide some input into what we are seeing in the funding markets as well. But just to recap on some of those points, we refer to it as the dry powder, the private debt funds. They're increasing availability. And we're seeing more coming into that space. So really good liquidity. And I mentioned it, private debt funds offer greater flexibility. So particularly for growth, any tech-backed businesses or indeed transactional debt, we are seeing them provide much greater flexible terms than a high street bank. For example, they have appetite to structure over 7 years, for example, whereas a high street bank's probably looking at 3 to 5 years maximum. They will also entertain what we refer to as bullet repayment structures, i.e. the loan amount doesn't need to be fully repaid in the time. It can be left with a bullet at the end, which requires to be refinanced. But both those factors in terms of appetite for longer terms and bullet repayment structures make cash flow significantly easier under less pressure, and that's good news. One of the themes that we're talking about that we've seen continue to rise is asset-based lending. So this is invoice discounting, asset finance, property funding, stocking finance, a real deep dive into all of the working capital aspects of your business and structuring a facility around it. It traditionally has been dominated and still is by invoice discounting, but in the last 2 years, we have seen much greater expertise and flexibility being deployed around proper asset-based lending facilities, i.e. we'll structure a facility against your debtors, but also part of it against your property, part against your stock, really truly delving into the assets on your balance sheet and realising the value within them. There's also some niche players in this space. Probably the most effective one that we have come across is selective invoice finance. So this does exactly what it says on the tin in terms of you can just take out one or two of your major debtors. Perhaps your debtor, you're extending them greater credit than you did before. You can just slip that one debtor and raise the funding against it to ease off your cash flow. It came onto the market. It's been on the market for a little while, but in the last couple of years, it's become slick. The portals that you use are easy. They integrate with your own soft finance accounting software. So we've just seen considerable improvements, not only in the product proposition, but in the mechanisms for accessing them. Another major theme, so in addition to the rise of the private debt funding that's available, the high street banks themselves are very much open. They obviously deployed significant amounts of capital during the COVID period. We saw a bit of a retrench as they tried to recover their balance sheets from that, but they are open again. And on speaking with the banking staff, as we do on a very regular basis, we understand now that they also have new targets to meet. So there's a much stronger appetite to look at new proposals, and that's good news. I alluded to it in one of the earlier slides. Again, a theme that we're seeing and we expect to continue to see is references to ESG policies, be it so at the end that I referred to, in one end where one bank didn't wish to put out terms until a client was able to articulate and show them their strategy. But to the more general end, and I'd say more reflective where it's at, at least people asking the question and holding the conversations, and banks, as I say, rolling out specific products and margin reductions in return for demonstration of ESG improvements in your business. So add it to the agenda if the lender doesn't do so themselves. Some of the more negative trends, so whilst it's great that we're seeing lots of liquidity in the market, we're seeing the rise of alternative funders and some more sophisticated products. One of the negatives that we're seeing at the moment, and this is more typically a feature of the high street banks, whilst they're very much open and they definitely have a desire to look at propositions, they remain conservative. At the lower end of the conservative side of things. And we are seeing what we would refer to as what we call a structural decline. What do I mean by that? That is typically where they will perhaps approve the request, but it wasn't for the full amount that you were seeking. Or indeed that they're stress testing, because we're in a rising interest rate environment, the banks will use a default base rate. You've got your margin to add on to that, as well as then whichever covenant 150%, 200%, whatever their policy is. We are seeing those factors constraining the amounts that banks are willing to lend. So willing to lend, but conservatively. The other constraining factor, it tends to be the serviceability at the moment, but we also are seeing very cautious valuations, property valuations coming back in the most recent times. So as I say, that's the most curtailing factors that we see at the moment. So what do you do in these instances? Well, this is where we would encourage you to be aware of the funding options that are out there. If you're speaking to one lender, I would encourage you to make it two. We've noticed as applications go through the process, they then are falling over for various reasons, be that perhaps you get to the stage of instructing the valuation, for example, it comes back lower, then you don't get the required funds. So that's why we would always encourage you just to have a couple of lenders looking at your request. It all matters. Not only does it help you ensure you've got competitive terms, but it will help lead to greater chance of success of raising the funding if you're not just solely reliant. And as I said earlier, if you don't know where to go for that, please do get in touch, because that's what we're here to help with. We have extensive knowledge of the funding market, and even if it's as simple as give you a few ideas of which lenders to speak to, we would be more than happy to do so. So I hope that has provided an introduction to our new service proposition here in PKF, and given you a little overview of some of the trends that we are seeing in the lending market. But the main message is please do get in touch if you've got any banking or funding inquiries. We'd be delighted to help. Thank you.